Hi, I'm Chanda Varma, and today let's speak about the most common money mistake that you need to avoid, and that is taking life insurance policy as an investment product. Now, for many of you, insurance policies are one of your main investment assets, whether it's pension plans, children's plan, 25-year money back plan, whole life plan, click to invest, Jeevan Anand, etc. etc. I have seen that most of you take these policies predominantly for two reasons: supporting your child's need in future and providing for some amount of safety like a pension amount for you or your spouse at a later stage in life. We feel the need to insure something in life, so we think that through insurance we can have some chunk coming to us consistently in later years. These needs are valid, important, but insurance policy is not the solution. Unfortunately, in our country, insurance has been missold for many years, and only now with IRDA there is some restraint. But I find most people are not aware of various types of insurance, how different plans work, how it is suited to them. And if this clarity is given, you all can make informed decisions. So first thing you need to understand, guys, is why life insurance? We all know why we take medical insurance, indemnity insurance, car insurance, but why life insurance? The reason we all take life insurance is because we are looking for some benefit that we will get at the end of the day. We look at insurance as an investment that will give us something back on maturity. Wrong. Big mistake. We do this because that's what we've known, seen, heard and learned from our elders. But insurance is not an investment for future. By its very DNA, life insurance means ensure. It means protection against risk of loss of life. Full stop. If anything happens to you, your family needs to be protected so they are not in any financial mess. It is safety. So from today onwards, do not ever buy insurance as an investment product. Let me now tell you the 5 reasons why. 1. If we all check our policies, and most of us will see that we end up buying multiple endowment policy, pension policies, whole life cover, unit linked policies of different amounts, because we are looking to get something at the end. The problem is these do not provide adequate life cover. I had a friend and he proudly had bought 2-3 insurance policies close to rupees 50 lakh as soon as he got a great promotion. But you know what? He had a home loan liability itself of 2 crores. He never thought that the two were related. Now tell me, if anything were to happen to him, would rupees 50 lakhs take care of his family's needs for life plus the repayment of the loan? No, na. Number 2. With these policies, they not only give you a low cover amount, but also their premiums are very high as compared to the cover they offer. You end up paying 10 times the premium you actually should be paying if you had the right policy. For example, a typical endowment policy for 1 crore for 20 years. If you're about 45 years of age, your premium is 5 to 6 lakh approximately per year. If you take the right policy, your premium would not have been more than 30,000 rupees approximately per year. And this difference, guys, is huge. The second problem is that the historical returns from such policies at max over a 20-25 period is between 3 to 5%. The ULIP policies may give a slightly higher, 8 to 9%. That's very low. The fourth problem is that we are trained to look at the maturity amount we will get in our hands, whether it's form of pension, lump sum, bonus, profits, etc. The amount looks big at first, but your money actually doesn't grow. For example, my father had a 75 lakh policies. The agent told him you'll get a revisionary bonus, and he did about 45 lakhs over and above 75 lakhs. So we thought, wow, 1.20 crores in our hands. When I sat down and calculated, I realized that he had made a gain of only 3% over these 20 years. The inflation in our country is at 6%. Our money never really grew. The maturity value does not beat inflation. So in case you're promised a 50,000 pension at the end of 10 years, will the purchasing capacity of 50,000 be the same 10 years down the line? Will it be sufficient? Fifth, the problem is that most of these policies have many charges as a part of premium. Allocation charges, admin charges, mortality charges, which most of us do not even realize that we are paying as a part of premium. Let's say you have 1 lakh as a premium amount. Do not be surprised if only 90,000 is invested and the rest goes in charges. This just means lower returns for the investor. The way insurance is marketed is amazing. All charts, figures we look at is very attractive. and we buy it without understanding nuances. We see so many ads by so many insurance companies. They talk about aapke saath bhi, aapke baad bhi, jeevan suraksha, sar utha ke jiyo, guarantees. And these words give us the comfort we are looking for. They appeal to our underlying emotional needs, security for children, old age needs, taking care of our parents. They look very tempting and sensible. So our emotions while investing is right. And finally, it's all about security, right? But the insurance solutions provided are wrong. We don't even know what we are taking. We think there is really something like a child's plan, for instance, but it's just another expensive policy marketed beautifully. So let's talk about solutions. What is the right thing to do? Life insurance is to be taken for two reasons only. One, you have a family who needs to be taken care of in case you're no more. Number two, if you have an obligation or plan to take one, whether a loan to purchase equipment for clinic or some space or a housing loan, take insurance to cover these liabilities. If anyone tries to sell you a policy talking to you about an investment for child's future or your pension or income for later years, remember, do not invest in insurance policies for that. There are other products for it. Second, do not buy policies which are pension, annuity, endowment, money back, whole life, unit linked. In general, these policies do not give enough cover, their premiums are high for the cover they offer, and they do not give you a good return over a 10 to 20 year period. Third, ask only for term policy. Let me explain term policy in a layman's language. It's like a car insurance. You pay a small premium per year to insure your car. If anything happens to the car, you claim insurance, else you don't. Do you expect a lump sum to be returned to you if nothing happens to your car? No, right? A term cover works in the same fashion. In case something happens to you, the entire amount goes to your spouse. If nothing happens to you, there is no money back, no lump sum amount at the end of the policy term. Because the premium amount itself is so low, it gives you a high life cover. It's a no-frills policy. It is the only policy that will give you the highest cover you need for a relatively low premium. If you take a term insurance cover for 1 crore, let's say at about 45 years of age, your premium would be around 25 to 30,000 per annum. But if you take an endowment policy, similarly, your premium would have been 5 to 6 lakhs per annum. The premium difference is huge. Let me tell you about this doctor family running a 100 crore worth hospital in Mumbai. He had invested in many policies, some 27 odd policies, and he had a cover of 3 crores. And he said, good now. He was paying a premium of 26 lakhs per year. And this was a doctor in his late 50s. He had more than 25 years of experience. He somehow obliged his agents, patients, and collected all these policies. Now, he had an outstanding loan of 10 crores for his hospital expansion. And I asked him, God forbid, if something happens to you, how will your family pay off this loan? They would have to sell some of their assets to pay up. Rupees 3 crore is not adequate. And he realized his mistake. His need was never calculated for him. He just looked at the policies as some sort of backup and more like investments. So finally, he took a term cover of 15 crore, 10 crore to cover the loan and 5 crore for his family needs. He stopped all the unnecessary policies. And do you know how much he saved in form of premium? He had to pay a premium of just 4 lakhs for 15 crore cover. Earlier, he was paying 26 lakhs for 3 crore. Saving of 20 lakhs. Fourth, another checkpoint. How much life insurance you need. Most of us, when we take insurance policy, we just pluck a figure out of the air, something that seems adequate. We rely on our insurance agents to propose and decide a policy and sum assured. It is not the right way to make the most important decision. Now, there are no thumb rules here. Everyone's needs are different, just like every patient is different. The only way of deciding this is by having a proper insurance plan calculator. This will give you a good idea of the amount of cover your family needs. It takes into account your earning life, your loans, your future expenses like education, marriage, etc., your dependents, their living expenses, the assets you already have. So take a term cover for the maximum amount that you can possibly take. To summarize, finally we all want our loved ones to be protected and us to achieve our goals. So ideally, what should you do? Take term cover and pay the required low premium. And the balance amount which otherwise you would have paid for an expensive policy with a high premium, invest it in different products for your goals, for either your child or your pension support. This way, you not only protect your family, cover your family, but also your long-term goals are managed more effectively to beat inflation. I so hope this helps you and you avoid this very costly mistake going forward. Take care. God bless.